Okay, so what we talked about on Friday was we went through like in a lot of detail the process for creating a journal entry. And then now we're going to talk about once we have made that journal entry, where does all the information go, right? So we know that we make a journal entry and then somehow it magically turns up in our financial statements. So today we'll talk about the mechanics of exactly how that happens. So once we've created our journal entry, so here in this example, they had a law firm that engaged a consulting company to provide some e-learning services, so some classes or whatever, and they're paying $600 in advance for those services. So under that situation, just like if we're buying an airplane ticket in advance, there's a prepayment before they've actually earned the revenues. So we don't want to record it as revenues right away because we haven't earned it, right? So by definition, in order for a revenue to be recorded, we have to have actually earned or substantially completed the earnings process. Meaning, if what they're buying is this e-learning service, then until they actually provide that service, the company they paid owes them that money or they owe them the service, one or the other. Same thing with the airline, right? So if I buy a ticket to fly someplace, usually a few weeks in advance, the airline either owes me a ticket or they owe me my money back, one or the other, right? They can't just be like, I don't think I'm gonna fly you anywhere. They have a liability to you. So unearned revenue is the type of account that we would use if somebody has prepaid us for something that we have not yet delivered. And that's true whether it's a product or whether it's a service. So we receive the cash. In this case, we are Smart Touch Learning in this journal entry. So we're receiving cash for $600. We're debiting cash for $600, and then we're crediting unearned revenue for that amount. All right. And so at the bottom here, we've got two T accounts where we can see, okay, we're in the, we've been through November and December, and we've had a variety of transactions that have been hitting our cash account. We've got deposits on the left-hand side, which have debited our cash account. And then we've got various payments that we have made on the right-hand side out of our cash account, which would be crediting our cash. And just as a quick reminder, when we're looking at these, if we think about our accounting equation, assets equals liabilities plus equity. Assets have a default debit balance because they're on the left side, and liabilities and equity have a default credit balance. So to increase cash, we would debit it. To decrease cash, we would credit it. And then for liabilities and equity, to increase them, we would credit them because they're on the right-hand side of the accounting equation. Okay. So just remembering that part also. And then that's also incorporated on this cheat sheet, right? So we talked about how every account has a normal balance, where if you have existing balances in that account under normal circumstances, this would tell you how to increase and decrease one of these account types. All right. So once we have that though, right? So this is kind of what we did last week. We talked about journal entries and we talked a little bit about reporting them into T accounts also, right? Yes? Or did we not get to T accounts? We did. Okay. That's what I thought. Once we have these T accounts though, we have to figure out what our account balance is. So for this cash account right here, we've got a series of transactions that increased the balance of cash, and we have a series of transactions that decreased it. So in order to figure out what our cash balance is, there's one more entry out there after this where somebody else paid them for some revenue. So I'll include this one. But to figure out what our ending balance is for this account, all we do is add up our total debits and add up our total credits, and then we net them against each other to figure out, if we take our total debits minus our total credits, if the balance is positive, then we have a debit balance. If the balance is negative, then we have a credit balance. So I'm just going to type those numbers from here into this homemade T account that I'm doing right here, and then we can see what the ending balance is in this cash account based on these transactions. So then if I total these up, I've got debits of 46,100 and I've got credits of 33,900. So taking debits minus the credits, that gives me a overall debit balance of 12,200 at the end for this cash account. Okay. So ultimately then, that's exactly what we do for every single account in our chart of accounts. We total up our accounting system, either us or the accounting system will total up the debits, total up the credits, net them against each other to figure out whether we have an overall debit or an overall ending credit balance. And then all of those balances will be taken and put into a list called an unadjusted trial balance, or I mean, just a trial balance for short. So once we do that, like they had a whole list of accounts here for various journal entries, and we went through some of our in-class exercises instead, but there are examples of very similar types of entries that were in the slides. And so we can see here they put this into the format of the accounting equation with the assets here, the liabilities here, and then all the things that go into equity are on the right. And then they netted all these out. So each of these T accounts here shows an ending balance for each of those accounts. So for cash, we had 12,200, receivables 1,000, supplies 500, prepaid rent 3,000, etc., etc. Okay. So once we know what the end balances are for each of those, we just grab them all and put them into a list format so we can kind of see them more clearly. Because when you look on here, there's a lot of, when we see all the transactions mixed in with the balances, it's a lot of information for us to process, and it's not like we can obviously find the information and the ending balances, but from a decision-making standpoint, it's hard to review them clearly and concisely when they're all like mushed into the balances and all of the transactions. So we grab those ending balances out and then we put them into this what's called a worksheet format, right? So this is how your computer essentially does it too. They total up all the debits, total up all the credits, net them against each other, and then at the end, so each of these individual transactions affects the overall balance in the account until they get to that $12,200 balance at the end. And then we pull it into this list right here, which is a trial balance. So that $12,200 cash balance is here. If we go back and trace these all back to that previous sheet that was in the format of the accounting equation, all these are those balances, the ending balances after all of the debits and credits were netted against each other. And then we see here, the reason that the trial balance is called the trial balance is because at the end of the period, they take all the numbers, they total them up, they make the list, and then they make sure that the debits equal the credits. So do the debits and the credits balance each other? If you made all your journal entries correctly and then you put them into your T accounts correctly, your debits in total should equal your credits in total. And if they're not, then it means that there's probably one entry that was like made into your T account backwards, or maybe more than one. And so before you could do anything else, you'd have to go back and figure out where you entered something in error and then correct it so that you have a trial balance that actually balances. Now, this trial balance, they're labeling this an unadjusted trial balance. That means we recorded a bunch of transactions as our activities were going on during the month, but it doesn't include some things that we may not have recorded. Like we may not have recorded what's called depreciation, where we expense some fixed assets over time. I'm not going to get into an in-depth explanation of that because that's like a couple chapters away. But there's a variety of different journal entries that we might need to make at the end of the month in order to make sure that these are correct. One example would be like, so they have a note payable here for $60,000. So they have a large loan that they've taken out, which is probably subject to interest. And so once a month or whenever you do your financial statements, you'd say, okay, well, how much do I currently owe in interest to the bank? And then you'd make an entry to record interest payable for the note. Or here they've got unearned revenue. Maybe at the time they recorded that unearned revenue, it hadn't been earned yet. So maybe they collected that money at the beginning of the month. And then later in the month, they performed the services. So we might want to adjust that to actually record the revenue for it. And so any of those month-end adjustments that we make are called adjusting entries. All right. Now, after adjusting entries, I'm sort of glossing over that right now, but after adjusting entries are made, then we would pull the balances from the trial balance into our financial statements. So these asset balances here are pulled directly off of our ending trial balance for each account. Same thing with the liabilities and stockholders' equity. The income statement numbers are pulled from the revenue and expense accounts. And then our statement of retained earnings would be includes any net income that we earned during the period, which comes off of our income statement. And then we would subtract any dividends that were paid during that period, which we kind of talked about those financial statements in chapter 1, right? So this just shows us the mechanics of how the information gets from our journal entries into these financial statements. And so the last problem number 7, is like a comprehensive example that walks through everything from those journal entries that we did on Friday through to the financial statements at the end. Okay, so looking back then at our looking back at our sample problems, go ahead and I'm going to have you work on this trial balance here. So they gave us the list of accounts, and I just want you to plug that into a trial balance format here. So the rule of thumb for how we do this is you want to put them in the order of assets first, then liabilities, then equity accounts. Normally, if you were actually using an accounting system, these would all be assigned account numbers, and then they would be in account number order. But since we don't have account numbers here, we're left to kind of do it in our own order. So think about going through each of these first and determining what type of account is it. Is it an asset? Is it a liability? Is it something that goes into equity? And then when you're looking at this sheet here, this cheat sheet that I gave you, you can kind of put the equity accounts in the same order. So like common stock, dividends, retained earnings, which would kind of go in here, and then revenues and expenses would be last. Okay. You could actually do common stock, then retained earnings, then dividends, revenues, and expenses. So take a minute to do that. And while you're doing that, I'm just going to plug in those journal entries back into problem number 10. at the end, because it doesn't save them for me, so that when we go finish going through that, I'll have those in there. Or I'm sorry, problem number 7. So what I'm doing is duplication of what we did on. Did we get through all of these entries on in problem number 7 on Friday? Or were there a couple we didn't do?
I think we go through more, but it was like last 5 minutes of class, so it's kind of fast.
Okay. Forgot that one. All right. So I'm just gonna save that. Oh shoot, hopefully it's not gonna make me lose that. All right. So did anyone have any issues putting together your trial balance at all? As far as it's just pulling the balances in, right? Okay, so let's jump back here really quick to problem number 7. Where we did those journal entries. We set up the journal entries on Friday, but we didn't do the T accounts, right? So let's go ahead and work on the T accounts for those ones. So what I'll do is I will scroll up through my entries here, and then y'all can work on your T accounts as I scroll down. Does that sound good? And then we'll go through them at the end, and you guys can tell me what to put in here. So the entries that we did, so what I would do for these is I would go through entry by entry and then put them down below. So I would take this $45,000 debit. I'll walk through this first one with you. So we've got $45,000 debiting to cash and crediting to notes payable. So if we're down here in our T accounts, the first thing I'm going to do is go to my cash T account here, and I'm going to debit that for $45,000. And I think that was April 2nd, right? And then I'm going to credit, and I talked too long. I received cash and it was for what?
Notes payable.
Notes payable? Okay. Oh, okay. You said notes, not accounts?
Yeah.
Okay. Okay. So we've got that entry. So go ahead and do the next one here. So you're going to debit your land. It's April 4th. And then you're going to credit your cash. So the nice thing is you don't even have to remember which side is which, right? Because if it's on the left here, it's going to go on the left side of the T account. And if it's on the right here, it'll go on the right side of your T account. All right, so everybody got that? Okay, so the third entry then was April 9th, debiting cash and crediting service revenue. So we're just entering those into the T accounts part, right? Huh? Oh, okay, so, I mean, you could be entering in the journal entries as we go through too, if you want. This is on problem 7. So you're, oh, you're already past. Okay, so, okay. Does everybody have the journal entries part done or no? Okay, then maybe I'll just go through the entries first and then we'll scroll back and do the T accounts. How does that sound? Because that's right, because I think we were kind of rushing at the end there. So this was the third entry, debiting cash and crediting service revenue. So then the next entry we had, we are purchasing supplies on account. So we are debiting supplies, crediting accounts payable, right? And I remember we did that one. Okay, and then on the 15th, we perform services for a customer on account. So if we're performing services, that means we're earning revenues, right? And revenues have a what balance? What increases the revenue account? Credit, right? So that if we did not receive the cash, we did it on account, then that's which account? What do we record that into? So if we hear the phrase on account, it means we either have accounts receivable or we have accounts payable. So if we perform services for them, are we going to receive money eventually, or are we going to pay money? Receive, right? So then it's going to go to accounts receivable. Yeah. So debiting accounts receivable and crediting service revenue. And then on the 18th, we paid $1,200 on account. So again, the on account phrase means that we are either paying or receiving. So if we're paying, then it has to be accounts payable. So what we would be doing there, though, is if we're paying something, we're also reducing our cash, right? So cash is an asset. To reduce an asset, we would credit it. So to reduce a liability, we would debit a liability. So same thing here. So to make the liability go down by paying for it, we would debit the liability of accounts payable, and then we would credit cash. Okay, so for the 21st, this one was kind of a more complex one because we had three things we paid for. We paid for salaries, we paid for rent, and we paid for interest. All of those, they're just saying that we expensed those. We're just paying them cash at the end of the month. So we're debiting all three of those expenses and then crediting cash. And then the description is paying cash expenses. Okay, now receiving $3,100 from a customer on account. So earlier we performed some services for someone and they did not pay us. So we debited our accounts receivable and we credited revenue. Now here, this is a case where the revenue was earned a while ago, but we've been waiting for them to pay it to us, right? So we don't want to record revenue again because we already recorded that. So what we do is we record the debit to cash to show that they've paid us the $3,100, but then we credit accounts receivable where we parked that asset waiting for them to pay us. So we're moving it out of accounts receivable and into cash. And so that was received cash on account. Okay, now on the 27th, we received a $200 utility bill. That's going to get paid the next month. I kept wanting to put accounts payable. That's the normal generic payable, but they specifically wanted utilities payable. So either way, utilities payable is an accounts payable. They're just maintaining a separate payable for that. Okay, and then on the 29th, we received $1,500 for services to be performed next month. So if we have not done that yet, then we have that liability for it, right? Just like in the last problem. So we're debiting cash to show that we received the cash, but then we're crediting that unearned revenue again. So that's exactly like the entry we just did. And then at the very end of the month, they decided that we had some extra cash. So we paid out some dividends. So remembering dividends reduce the pile of money that we're building up over time as we have net income. So they would reduce our retained earnings. Retained earnings has a credit balance normally, but if we're reducing it, we're debiting it. And then cash, we would be crediting. So again, if you just ignored everything we knew about retained earnings and dividends that are being paid, and we just thought about the cash, we could say, all right, well, we're paying some cash out. Cash is the easiest one to remember. It's an asset. assets are on the left, debits are on the left. If I want my cash to go down, I'm gonna go on the right, which is a credit. So then you know the dividend has to be a debit because you're reducing your cash. So anytime you have cash, you can kind of back into what the other side should be, whether it should be a debit or credit based on what you're doing with the cash, right? So it's helpful if you can kind of memorize the cash part first, because you can use that relative to other things to figure out how to do your journal entries. All right, so I'll scroll back up to the top now, and then if you didn't do the T accounts before because you didn't have these done, we'll go through this a little faster. So we already did that one, right? So putting your cash on the left-hand side of the T account at the bottom and the notes payable on the right, and then don't forget to put the date as April 2nd on there. And the nice thing is you don't have to worry about really formatting. Oh, the one thing I will say on these, you don't have to go to a new line on these. Just start at the top line. So like if you have a debit to cash, put it in the top line. If you have a credit to cash, put it in the top credit line on the side, because they'll expect you to use all those spots. So don't skip any, like don't go first line and then second line and then third line. Unless they're all like debits in a row or something, because you'll run out of lines. Okay. So what do we got here? We've got, so land and cash, 40,000. I bet you I got the wrong, so I was thinking April 9th, and I think oh, 5,000, okay. I hope so. Oh, 15th. All right. I'll just take a screenshot of that one.
let's see, salaries, rent, and interest. So 3,000. This is kind of tedious, right? We won't do this for everything all semester. It's just mostly this chapter here. Let's see, so rent 1,500, interest 400. All right, how's everybody doing? What did I do with that 2,600? Looks like I did something I wasn't supposed to. 3,100. Oh, that was service revenue. I put that in the wrong spot. With debiting, that's why. Okay. I'm supposed to debit that one. So it's very easy to transpose something and like forget it while you're scrolling around and get a debit versus a credit. So we'll go through all of these as a group here in a minute. Okay, so once you've copied all of those down into the T accounts, then what we have to do is go through and like total them all up and figure out what our ending balance is. So here we've got like if there's just one line item, it's super easy. All right, we have it started out with 0, there was $1,800 debit. So it's $1,800 at the end, and then label it the balance. So go ahead and you can kind of do those ones really easy. We've only got a couple of accounts where did we actually sell any stock? I don't think we did we? In this problem? I don't think we did. So if there's no transactions, then whatever the beginning balances would carry through. If there's just like one transaction and it started out with a 0 balance, then you can just pull that down. So this one here had a starting balance and it had a transaction. So this one for rent, I would add those together then. And then I'm gonna kind of pause on these ones that have more than one line here just until I get everything else. How did I get that? Looking at something else there, apparently. All right, so then if you have ones where there is more than one line, but they're all on one side, then you can just add them together. So like the service revenue, I just went 10, 15, 17,600 to get that one. But let's talk really quick about how we do this when we've got debits and credits. Well, what you're going to want to do is enter in all the debits and all the, like, make a total of all the debits and a total of all the credits, and then net them against each other. So here for cash, I started out with 23,900. And then we added in 45,000 at one point, we added 5,000, we added 3,100, and we added 1,500. So we had total debits of 78,500. Now I'm not going to put those over here because what they want here is just what the ending balance is. They don't want me to total them all up and put the subtotals. So I'm doing this on my own on like a piece of paper or a spreadsheet or something. Okay. So on this other side, I've got 40,000, 1,200, 4,900, and 1,800, assuming I didn't write any of those wrong. So I have credits of 47,900. All right. So what I'm going to do then is I'm going to take the debits here minus the credits and net them against each other. Because if I have more debits than I have credits, then I will get a positive number, and then I know I have a debit balance. If I have more credits than debits, I'll get a negative balance, and then I'll know I can treat that like a credit. Okay, so I'm coming up with, assuming that I didn't enter anything in here wrong, which we'll just cross our fingers on that one, was 30,600. Oops. Right, and then I'm going to do the same thing here. So I had accounts payable, and I started out with 2,000. Oops, and then I'm going to enter these in here. So I had a total of 1,200 in debits, 2,300 in credits. 1,200 minus 2,300 gives me minus 1,100. So that would be a credit balance then of 1,100. So then I would just enter this in on the credit side here. Okay, so then I think receivables also had some stuff. Okay, yeah, so oops, yeah, so that was my payable. So let's go ahead and do the receivables now. So 4,500 and 2,600 on the debit side, and then 3,100 on the credit side. So that gives me an ending balance of 4,000 debit balance. Okay, and I think I've got balances for everything in here now. All right, now let's see if I made any typos. Oh, all right. Okay, so we'll go back through that in case anybody did not. Does anybody need any extra time to enter these in, or did you get them all? Got them? Okay. All right, well, so now we know what the ending balances are for all of these. So now we can plug them in and we can create a trial balance just like we did on that other problem. So we're going to go through one account at a time, and we're going to create our adjusted trial balance. So because I have to get it entered in here, well, who wants to be the well, let's see. So we've got, let's just go through these in order. We'll go down the left column, the middle column, and then the right column. And if you'll give me all the account names first, then we can plug in the balances afterwards. All right. So we have cash, right? And then was it accounts receivable? Yep.
Supplies. Land.
Okay.
accounts payable, utilities payable, unearned revenue, notes payable, common stock. Accounts, service revenue, salaries expense, rent expense, interest expense, and utilities expense.
Okay, so in order, that was super fast, like I was flying to get that in there, so we'll go through this more slowly here. So just copying the names of all the accounts down, and they were kind enough that the first column was assets, the second column was liabilities and equity, and then the third column had revenues and then expenses in order. So that was just how we got the order here. We just went like right down the three columns that they had in there. So cash, accounts receivable, supplies, land.
Did I get those payable?
I don't think there was, oh yeah, so notes payable was down below. So when accounts payable, utilities payable, unearned revenue, and then notes payable. And the reason they went in that order was because they're also looking at order of liquidity here. So which of these, how quickly are these expected to be, are to use up our cash, right? So accounts payable are usually things that are due right now, between now and 30 days. So that's usually the most at the top of your list of liabilities. Utilities payable is like a sub-classification of payables there. Unearned revenue, we've already received the cash, but we have to convert into like a service or a product delivery in order to earn that. So it's less, considered less liquid, even though we've technically already gotten cash for that one. Notes payable by nature are something that is at least like 60 to 90 days usually. So those will be by default lower down the list, and they could be as long as like 30 years or something. So that's why those are on the bottom of the list of liabilities. And then once we're past the liabilities, common stock is pretty much always first, followed by retained earnings, dividends, revenues, and expenses. So that's the order they will typically go in. And then the expenses are, they don't seem to have a, so interest expense is like an other expense, but the other two are operating expenses. That doesn't seem like they really care maybe what order those are in, but we just put them in the order they had them up above. So then it's just grabbing the end balances that we've already calculated and then plugging those in. So for cash, we had an ending balance of 30,600. So make sure you put it in as a debit down there. Accounts receivable, we had a debit balance of 4,000. Supplies, we had a debit balance of 300, right? And then land, we had 40,000. So those are all of our debit balance accounts there in that column. Now we're switching over to liabilities. So make sure you put these in as credits, right? So the accounts payable was 1,100. And then utilities payable was 200. The unearned revenue was 1,500.
It added what order you're in?
Well, because we had the accounts, we put all of them in at the bottom, right? So we already have them in here in this order. So I'm just going down the list. So yep, so make sure you put like the notes payable one goes on the notes payable line, etc. So for notes payable, we had 45,000 up above. So we would plug in 45,000 down here in the credit side because that's a liability. So just to show here, like, so 30,006, 4,000, 400, I think it was it 4,000 or 400 for accounts payable or receivable?
4,000.
Okay, and then let's see, so 300. And then up here we had the 1,100, 200, 1,500. Okay, so then common stock, our balance up here, we had 18,500, also a credit balance. And then the dividends there, because that reduces our equity, don't forget to put that one in as a debit balance. That's sort of the odd man out in this column. That one's a debit balance, right? And then service revenue, these ones are all over. So you want to watch these. Service revenue, credit balance of 17,600. And then those three expense accounts, those are all going to be debits. And we had 2,500, 400, and 500. Oops, where did I end up? Did I have missed one? Wait, so 20? Oh, I missed salaries was 3,800. Shoot. Okay, hold on. Here I am screwing y'all up. And that one was actually 3,800 there. So I'll leave that up for a second so everybody can see that. They could have at least been nice and totaled it for us. Hey, they're not making it easy. All right, so what I'm going to do then is I'll scroll this over so that I can add these up then. I'm just plugging these in on their respective sides so that I can add them up. All right, so now we just total each column. So these are all the ones that I had on the left-hand side here. And then these are all the ones on the right-hand side. And if I did this right, then they should be equal, which they are. So 83,900. I totally recommend using a spreadsheet. If you don't have Microsoft Excel on your computer or device, feel free to use Google Sheets. Everybody's got, does anyone here not know how to access Google Sheets through your CSS account? So if you go into your email, well, there's a couple ways you could do it actually. So you don't even have to go into your email. You could just go to the main Saint Scholastica page and go to Google Drive. And then you can do new Google Sheets. And then it'll just set up a web-based one and it'll save it like right in your My Drive folder. So if you want to save something out there, you can. And then you can just type stuff in here and use it as a calculator. It's so much, if you're working on accounting homework and stuff, using a spreadsheet as a calculator instead of like typing it into your cell phone calculator will save you a lot of time and frustration, because if you get something wrong, you don't have to like re-enter it all in there 800 times trying to figure out where you're making a typo. You can actually go through and see what you added up and compare it to what you were supposed to be putting in there and just fix what's wrong. It'll be so much easier for you problem solving when you do your homework if you do that. So like if I was typing this and instead of typing 1,800, I typed 8,100. I can see, oh my gosh, like, wow, they're not adding up. And then I can say, all right, well, what's the difference here? Or I can just go through these and be like, oh, that one was supposed to be 1,800 and it's 8,100. So you can just fix that and then re-add it up. And then you'll have it fixed, as opposed to like if you were tending to make a particular mistake when you're entering something in on your calculator on your phone, you'll probably tend to make it more than once. So it's just a time saver. So obviously you don't have to, you can do what is comfortable for you, or you can do it on paper and then add it up. But anything you can do to reduce like clerical errors when you're adding the stuff up will make it easier for you to learn the stuff, because then you can concentrate on like the method instead of having to worry about doing the just simple adding wrong, right? Okay. All right, so we went through that and we got all the way through creating that unadjusted trial balance there. And then y'all did number 4, right? So here's what you should have come up with on number 4. Hopefully everybody it was the same concept that we just did at the end of problem number 7. They gave you some T accounts and you just had to grab the ending balances and pull them down, right? Okay. So I'll just show this in case anyone has any questions on that or got stuck. But that's what everybody should have come up with. Okay, oops, I put the answers in there. Oh my gosh. All right, so the accounting cycle, which we talked about in our in the slides, and I didn't really describe this definition, but the accounting cycle is the process that we go through when we're preparing our financial statements for a period of time. And basically, we start with our beginning account balances. We analyze and journalize, create journal entries for any transactions that happen during the time period as they occur, right? So during the period, or like during the, let's see here. We're journalizing them in the ledger. Sorry, that's what they're looking for. And then we would post the transactions or journal entries, post the journal entries to the accounts in the unadjusted trial balance, and then we would prepare the financial statements. So that should be it. Hold on a second here. Yeah. Oh, what did I get wrong? Oh, hold on. Here, we'll just pull that up. Oh, in the journal they wanted. So in the journal as they occur, post the journal entries into the ledger, and then prepare the unadjusted trial balance. So I got ahead of myself, skipped a couple steps. Okay. And that's basically what we did in the end, was we recorded those journal entries in the problem 7, and then we put them into a journal. They had us put them into the journal, then post the balances into the ledgers. What they used was the T accounts in place of the ledgers, and then take the ending balances and plug them into the unadjusted trial balance. All right, so then for the last one, let me just, I got 1 minute left and I'm gonna make it count. Let's go out here. Where am I? I want to find you guys the slide here for the ratio. Here we go. There we go, debt ratio. So the debt ratio is basically looks at the comparison between our total liabilities and our total assets. So once we've done that whole process and we've got all of our account balances for the end of the period, we can take our total liabilities divided by our total assets, and it'll tell us if we have more liabilities than assets, and if so, how out of whack we are. And it also, the nice thing, gives us a basis for comparison to other organizations. So plugging that into our problem here, if we've got our total liabilities divided by our total assets, right? So just right off of our slide number 59. If they're giving us all of these, what we would need to do is add up all of our assets and divide it by all of our liabilities. So here, the only asset we have is, it looks like to me, is cash. Oh, no, we've got cash and equipment. So we've got $17,000 in assets there. So we would plug that in on the bottom. And then as far as our total liabilities goes, whoops. So unearned revenue, that's a liability. And expense. Oh, accounts payable, that's one, right? And that's it. Everything else is either assets. So that gives us 6,800 then for the numerator. So 6,800 divided by 17,000, assuming I did my math right. Is 0.4, 40%. All right, so that's it for the in-class exercises. Thank you for sticking around for the extra minute. I appreciate it. And we will, we might talk about a couple wrap-up points on chapter 2 on Wednesday, but you should be good for the things you need for the homework. And then we'll start in on chapter 3 on Wednesday.